Welcome back to Talk Tickers, where we strip down the earnings calls and just give you the alpha. We're skipping the fluff, ignoring the PR spin, and getting right into the machinery of the market. Today, we're breaking down the Q4 and full year 2025 print from a company that has been the absolute quiet giant of many portfolios for decades, O'Reilly Automotive, ticker ORLY.
It's good to be back. And you're right. Usually O'Reilly is this boring, reliable, steady Eddie that you just buy and forget about. But this quarter, it turned into a bit of a battleground. We've got a classic good revenue, bad expense story unfolding here. And the market reaction was, well, let's just call it grumpy.
Grumpy is putting it mildly. The stock took a 4% haircut, dropping down to that $92.86 range after the print. And looking at the numbers, it feels like there's a real conflict between how much stuff they're selling, which is frankly a lot, and how much it's costing them to, keep the lights on.
That's the perfect analogy. The street is really debating whether the strong sales momentum, and make no mistake, it is very strong, can outrun the sudden, sticky spike in operating costs, specifically healthcare and insurance. And management admits these costs are proving a lot harder to shake than they expected. So while the top line is singing, the bottom line is getting squeezed just enough to make investors sweat.
Okay, let's unpack this. We have to start with the headline numbers, because if you just glanced at a summary, you might actually think this was a blowout quarter, in a good way.
It really does look that way if you only look at the top half of the P&L. Revenue came in at $4.414 billion. The consensus on the street was sitting at about $4.39 billion. So that's a solid beat. They grew revenue 7.8% year over year.
And that's huge in this environment.
It is. I mean, pause for a second. We're in a retail environment that everyone keeps describing as cautious or choppy. To put up nearly 8% growth is massive.
That is significantly higher than inflation, so it's real growth.
Yeah.
And the comps. I mean, O'Reilly is famous for the comp streak. That is their whole badge of honor. Did they keep it alive?
They didn't just keep it alive. They flexed it. Comparable store sales were absolutely the star of the show. Q4 comps were up 5.6%. That brought the full year to plus 4.7%. And to put that in perspective, this marks their 33rd consecutive year of comparable store sales growth.
Let's just stop on that for a second. 33 years. That means they grew comps through the dot-com crash, 2008, COVID, the post-COVID inflation spike, basically every economic disaster of the last 3 decades, and they still sold more parts every single year.
Exactly. It's an operational dynasty. It shows that the business model is just incredibly resilient. People need to drive, cars break down, and O'Reilly is there. That streak is the core reason people own this stock.
Okay, so if the revenue's beating and the comps are up over 5%, which is fantastic for a mature retailer, why is the stock down 4%? What happened to the earnings?
That is where the tire hits the curb. Diluted EPS landed at 71 cents. The consensus estimate was 72 cents.
A penny. They missed by a single penny and the stock drops 4%. That seems harsh.
In a vacuum, a penny doesn't matter. But in a market that is priced for perfection and O'Reilly always trades at a premium multiple, a miss is a signal. It forces you to look at why they missed. It wasn't because they couldn't sell windshield wipers. It was because the cost of doing business jumped unexpectedly. It signals their legendary efficiency just hit a speed bump.
Right. Before we get into the villain of the quarter and those expenses, I want to check on the gross margins. Because usually if costs are up, you worry that maybe they're discounting to move inventory. Was that the case?
No, and that's the silver lining here. Gross margin actually expanded. It hit 51.8%. That's up 49 basis points year over year. That is a very healthy number. It tells us they have pricing power. When their suppliers raise prices, O'Reilly just passes that right along to the customer, and the customer pays it.
Okay, so the core business model's fine. The machine works. Let's dive deeper into that revenue engine. In the notes, you highlighted this tale of 2 customers, the Pro versus the DIR. What's the dynamic there?
This is a trend we've seen building, but it was just stark this quarter. The do-it-for-me side, the professional installers, the independent garages, that is the driver. Pro comps were up over 10%.
Wait, for the quarter?
For the second consecutive quarter.
Double digits back to back. That's massive growth for the boring auto parts sector.
It's huge. And it implies they are aggressively taking market share from competitors. You have to understand, an independent garage operates on throughput. Time is money. If a car is on the list, they need the part now. They can't wait 4 hours for brake rotor. O'Reilly's distribution network is just winning that battle. They are faster.
I also wonder if car complexity plays a role. I mean, I consider myself handy, but I pop the hood of a modern car and it looks like a server room. I'm not touching that.
You nailed it. That is exactly why the DIY side is so much softer. The do-it-yourself segment saw low single-digit growth. And actually, traffic, the number of people walking through the door, was slightly negative.
So the average Joe isn't coming in as much.
Right. Management noted specifically that discretionary categories are down. So we're talking about appearance products, accessories, the fuzzy dice, the fancy wax. Those things aren't moving. People are buying what they need to keep the car running, batteries, brakes, wipers, but they aren't splurging on making it look pretty.
That makes perfect sense given the macro. If your grocery bill is up 20%, you fix the squeaky brakes because you have to get to work, but you skip the new floor mats.
Precisely. It's utilitarian spending. And here's a crucial detail on that growth. It's being driven by ticket size, not traffic. Average ticket growth was in the mid-single digits.
Is that just inflation? Are we just seeing the results of higher prices?
A lot of it is, yeah. Same SKU inflation was about 6% in the quarter. Remember, they had tariffs passed through earlier in the year, and those prices have stuck. So customers are paying 6% more for the same alternator. That drives revenue up even if the same number of people walk in.
I saw a note about the weather. Usually retailers use weather as an excuse for bad results. Oh, it rained. Did O'Reilly actually benefit from it?
For once, yes. December was their strongest month of the quarter, specifically because of favorable winter weather.
Wait, favorable winter weather means bad weather?
In the auto parts world, yes. Good weather is bad for cars. You want extreme cold. Cold snaps kill batteries. They freeze wipers till they snap. When the weather gets nasty, O'Reilly sells parts.
Okay, so that's the good news. Revenue's flowing, pro-business is booming. Now we have to talk about the bad news, the reason the stock is down. The villain of the quarter, SG&A expenses. Why did the cost of doing business jump so much?
This is what spooked the algos and the fundamental guys alike. SG&A per store rose 3.3% in Q4 and a whopping 4% for the full year. In a business like this, you rely on operating leverage.
Let's define that for the listeners quickly. Operating leverage basically means your sales should grow faster than your expenses, right?
Exactly. Once you pay the rent and turn on the lights, selling one more spark plug shouldn't cost you much more, so profit margins should expand. But in this quarter, expenses grew almost as fast as sales. That leverage just disappeared.
And you said this isn't operational waste. They aren't just being lazy with the thermostat or something.
No, this is highly specific. It's self-insurance volatility. O'Reilly, like a lot of large companies, self-insures for things like employee health care and vehicle accidents.
Hold on. So instead of paying a premium to, say, Blue Cross or Geico, they just say, we'll pay the bills ourselves. Why would they take that risk?
It's actually very common for massive companies. Over time, it's cheaper. If you have 90,000 employees, the law of averages usually works in your favor, and you save the profit margin that the insurance company would have kept. But the downside is volatility. You are exposed to the actual claims. And in Q4, those claims just skyrocketed.
What specifically blew out the budget?
Two things. First, team member healthcare costs. More employees getting sick, more expensive procedures, just general medical inflation. That line item jumped. Second, and this is the frustrating one, vehicle fleet liability.
You mean their own delivery drivers are getting in car crashes?
Yes.
Yes.
Auto accidents. Remember, they're growing that pro business, which means more trucks on the road rushing parts to mechanics, more miles driven equals more accidents.
So they are selling more parts to repair shops because they're driving more, but in the process, their own drivers are crashing into things and costing the company money.
It is a cruel irony, isn't it? But yes. And crucially, management said they are cautious about these costs persisting into 2026.
Ah, that explains the reaction. If you can't predict your healthcare costs, it's hard to predict your EPS.
And that uncertainty is what the market hates. You can model how many brake pads you'll sell. You can't easily model how many delivery trucks will get rear-ended in rush hour.
If these costs are structural, that eats into margins permanently. It's like running on a treadmill where the incline keeps going up.
That's it. If costs rise at 4% every year, you have to grow sales at 6 or 7% just to keep your profit margin flat. You are running faster just to stand still. That is the bear case.
So what does this all mean for 2026? They gave guidance. Did they map out a way to outrun these costs?
They gave us a realistic map, I'd say. For sales, they're guiding for 2026 comps of +3 to +5%.
That seems pretty standard for them, right in the sweet spot.
It is. It implies they expect to continue taking market share in what they call a stable industry. For EPS, they're guiding $3.10 to $3.20.
Which puts them back on a growth trajectory, despite the costs. Now, I want to pivot to something that often gets overlooked, strategy. You mentioned a new distribution center in the notes, Stafford, Virginia. Why does a warehouse in Virginia matter?
Oh, this is a huge deal for their long-term growth. They just opened this massive facility in Stafford, which is right on the I-95 corridor.
The artery of the East Coast.
Correct. And historically, O'Reilly has been under-indexed in the Mid-Atlantic and the Northeast. They started in the Midwest and the South. The I-95 corridor from D.C. up to Philly is incredibly dense, but you can't service that market if your trucks have to drive 6 hours. Speed is everything.
So the Stafford DC is basically their beachhead for an invasion of the Mid-Atlantic.
So aggressively, it allows them to flood that zone with inventory and offer that 30-minute delivery to thousands of shops they couldn't reach before. It unlocks a huge population center.
What about the international side? What's happening in Mexico?
Mexico's going through a fascinating transition. Historically, their business model there was selling to jobbers, wholesalers, middlemen. It's a low-maintenance way to sell parts, but it's also lower margin because you give the middleman a cut. Now, O'Reilly is shifting toward company-owned stores there.
Cutting out the middleman.
Exactly. They want to control the entire chain, just like in the U.S. In the short term, this actually hurts revenue a bit, but in the long term, it helps gross margin significantly.
Let's zoom out to the investor context. What's the macro read? What did management say about the consumer?
They describe the consumer as cautious but resilient. They are seeing the trade-down effect in real time.
Let's explain that trade-down.
It's the choice you make when money is tight. New car prices are sky high. Interest rates are high. So instead of trading in your 2018 Camry for a new one, you decide to keep it. You trade down from buying new to fixing old.
Which is historically very good for O'Reilly. The older the fleet, the more parts break.
Exactly. The average age of cars on the road is at an all-time high, something like 12.6 years. That is a massive tailwind for this industry.
Okay. That brings us to my favorite part of the show. We've looked at the numbers, we've looked at the strategy. Now let's get a little creative. This is the not financial advice segment.
Standard disclaimer. This is absolutely not financial advice. Do not do this. You will likely lose money. We are just brainstorming wild trade ideas based on the data.
What have you cooked up for us today?
I call this one the hypochondriac hedge, or maybe the bad driver arbitrage.
I am intrigued. And slightly concerned. What's the setup?
Okay, look at O'Reilly's P&L. What is their biggest problem right now? It isn't selling parts. They're great at that. Their problem is paying for their employees' doctors and their delivery drivers' fender benders.
Right, the self-insurance line item that wrecked the quarter?
So here's the pitch. You go long or lie. The 33-year comp streak is undeniable. They are the best operators in the space. You want to own that revenue engine.
Okay, long or ROI. That's the sensible part. What's the hedge?
You go long a basket of health insurers and collision centers.
You're hedging the company with the people who are costing them money.
Think about the logic. If O'Reilly's SG&A is blowing out, why? Because medical inflation is skyrocketing and accident claims are up. Who receives those checks? The health insurance companies, the hospital chains, and the collision repair centers.
That is twisted but brilliant. It's a perfect internal hedge based on their specific P&L pain points.
Exactly. If O'Reilly's costs go down, the stock rips because their margins expand. You win on the long. If O'Reilly's costs go up, sure, the stock might dip, but your insurance and hospital holdings are paying for that dip because they are cashing O'Reilly's checks.
It's the bad driver arbitrage. If the O'Reilly drivers keep crashing, at least your collision center stock is going up.
It's hedging the specific operational risk of the company with the beneficiaries of that very risk.
I love it. Again, do not do this. It's a terrible idea, but it really highlights where the money is actually flowing in this economy.
It certainly does. One man's expense is another man's revenue.
All right, let's bring it home. Recap time. O'Reilly proved they can sell parts in any environment. Rain, shine, recession, inflation. The revenue engine is pristine.
But the street is demanding they get a handle on the rising cost of doing business. The revenue beat was nice, but that EPS miss stings. The market needs to see that SG&A line stabilize.
Final thought for the listener.
Watch the SG&A line in Q1 2026. That is the only metric that matters right now. Forget the comps for a second. We know they can sell parts. If the healthcare costs normalize, this dip is a buying opportunity. If those costs stick, margins stay compressed, and the stock could be dead money for a few quarters.
It all comes down to the expenses. Thanks for listening to Talk Tickers. Keep your eyes on the tape.
See you next time.